Tonight, we're talking about wealth building through real estate. So thank you for joining us. My name is Stacy Martin. I'm with Keller Williams Realty, the Martin Dream to Home team. I'm part of the luxury division. And tonight we're going to talk about some main things, which include learning the importance of setting goals in real estate and learning ways to make money in real estate, what types of assets to focus on, where to find assets that best align with your goals, and also options to finance a real estate investment. So, Ed, do you want to introduce yourself?
Yeah, hi, I'm Ed Martin with KW Commercial, and I'm part of the Martin Dream to Home team as well. I deal with investors, business owners, and property owners on a regular basis. And one key thing about commercial, I'm usually dealing with people that are making financial decisions about space for either where they're trying to grow their business or how they're trying to grow wealth.
Yes, exactly. So we're going to start with the first one I mentioned, which is learn the importance of setting goals for wealth. So what are the primary things you need to focus on, Ed?
So you got to make some decisions about what are you trying to do. Is your goal that you want to purchase to be a landlord, or you want to purchase to add value to the real estate and then do what's called flipping? So essentially maybe finding a depressed asset or an asset that you could put your own sweat equity and some of your contractor partners' efforts into and renovate it and then try to sell it for a profit. Of course, we never want to discount purchasing where you live as a primary residence, because your primary residence is a great place to build equity and you're getting the benefit of dwelling there as well. The statement, as Stacy would say, your residence is a wonderful long-term asset. But you have to think, am I in this to build a portfolio of assets that I want to be a landlord of, or am I trying to grow my wealth by stepping from asset to asset and following the flip cycle to do that? Some people choose to do both. So you really have to decide what's your approach that you're going to take.
Right. So the next one is learn ways to make money in real estate. So talking a little bit about those four things.
So Stacy and I often talk about there's 4 ways to make money in real estate. It's important to recognize all 4 are valid. One is cash flow. Buying real estate strictly for the cash flow that comes in to you. Another one is equity. Your goal can be, or your approach can be, I actually want to grow long-term equity in real estate over time. A third is if you're using leverage for your real estate investment, you're benefiting from the principal pay down. So a lot of people think, oh, wait, I'm not covering my, I'm not cash flowing enough, but perhaps you're taking enough income and you're actually paying your principal down into the future. And then a nice key distinction about real estate is you're able to take the depreciation expense every year of that asset against your taxes. So you actually make money through tax savings every year when you invest in real estate. So your approach to making money could involve 1, 2, 3, or all 4 of those methods. And you could have any of those goals guiding your decision on where you want to buy and what you want to buy. Any of them are valid. Very rarely is cash flow and equity completely aligned. So it's kind of important that you decide, is this next investment I'm making focused on cash flow or equity? So for example, here in the Northern Virginia area outside Washington, D.C., most investments are focused on people taking an equity approach because property values are higher and multiples for cash flow are not that great. If you go to more remote areas, you might have more of a benefit of taking a cash flow approach to growing or to making your money in real estate.
Absolutely. So the next one is asset types. And we're going to talk a little bit about the residential side versus the commercial side. So the residential side, that's where you would be purchasing a house that you would live in, so to speak, right? It's only zoned for people to live there. And there's all kinds of things in residential as far as that goes. So there's condos, there's townhouses, there's condo townhouses, there's single family houses, there's more like condos that are apartment buildings. So there's a bunch of different types of residential, but they're all still residential. Where we get into some, high level details is in commercial, because there's a whole lot of different types of commercial. So Ed's going to talk about those.
I get the question often, Ed, how's the commercial market? And it really depends on the asset type and the zip code. Because in commercial, we have multiple asset types that each have their own economic cycle. For example, office, whether it's a high-rise office building or office condo, office is going to have its own distinct use cases. Then there's retail, and retail is a wide array of things from hair salons to shopping malls to grocery stores to barbershops to restaurants and beyond. There's so many things that fit into the retail space. Even daycare or childcare can fit into the retail space. Then you
I
have
wanted to mention that actually, Ed, both of us missed one thing on our list, which was land.
Yeah,
So
that's
land,
right.
Land for
is
real estate and land for commercial, totally different things. So if there's
yeah,
a piece of land and you say, oh, there's a piece of land over there and I'd like to go build a house, well, we have to deal with zoning. We have to call the
right,
county, make sure we figure it out. So
right.
Ed has a lot of
No,
experience with commercial land.
Stacy's right when she talks about uses. Residential assets, a dwelling is a dwelling is a dwelling, whereas in commercial, we really get into what the zoning ordinance for where we're looking at that property allows you to do. So there's office, there's retail, as I mentioned. There's also industrial. Industrial will be like warehouses or data centers or self-storage facilities all fit into industrial. Maybe truck terminals can fit into industrial. And then there's multifamily. And I want to pause on multifamily quickly because you can asset multifamily really is residential and it gets depreciated like a residential asset because people are living in it. However, when we look at financing for multifamily, anything 4 units or smaller is considered residential. But if it's 5 or more units, it's considered commercial because that's how the lenders look at it. So it's usually a commercial property if it's 5 or more units. So like a high-rise apartment building or a mobile home park that is a certain amount of units that's above 5, it's going to be treated as a commercial investment by the lending community. Also hospitality, hotels, that's its own type of asset. And then there's specialty properties like laundromats or churches or maybe event venues that have their own economic patterns as well. A common thing that first-time investors look for when they're thinking about dipping their toe in commercial is something called mixed use. And when you go to your more urban areas, you'll see that you have retail with maybe office above, or maybe retail or office with apartments above. That's called a mixed use property. That's kind of a way to get exposed into commercial while still getting familiar with, or still staying familiar with what it's like to have apartment dwellers as your tenants. Stacy touched on land. And the reason why land is its own asset type is it's going to vary whether it's zoned for residential or commercial and how ready it might be for improving. But some people do like to put their money in land and let it sit because land really doesn't do much until you hold on to it for a while and either improve it or maybe sell it down the road at a advanced value at that later point in time. So those are kind of the asset types, and each one of those asset types behaves differently. And in the zip code, it might behave differently. You might find office closer to the capital in Raleigh is doing a lot better than office closer to NC State University. It just may vary depending on what zip code you go to. We run into that in this area where office in downtown DC is not doing that well right now, but office out by Tyson's Corner is doing very well.
Right. One other item that I failed to mention that I just thought of when you were talking is that there's new home sales as well as resales. And so what that means is when it's a resale, you're purchasing it from an owner who already has invested in it and is an investor and has a tenant in there, or maybe it's vacant, or maybe they dwell in the property themselves. That's a resale. When it's new construction, it means a builder is selling it brand new. And so sometimes investors like to get in and go write the contract with the builder before it goes live to the public, or they have a model there. Once they have a model and they start selling and getting on a roll, the prices go up and up. Get in quickly at the beginning, before, everybody's there and buy it off the blueprints, you can sometimes get a better deal buying new. And then when you have a new property, maybe you want to move in and enjoy it for the first year. And then maybe you want to then rent it out for a couple of years and you move on to something else. And there's ways to save money there too, which we'll get to in a few minutes.
Great suggestion.
Yeah. So the next thing we're going to talk about is where to find assets that align with your goals.
Yeah, so I mentioned earlier about cash flow versus equity investor, and I touched on a little bit about property values. As realtors and real estate professionals, we have access to a variety of tools. One of which is the National Association of Realtors market data that they keep on different areas. So I pulled up 3 just to make a point. What we're looking at here is the Washington, D.C., Arlington, Alexandria area. And you'll notice in the middle of 2022, we were looking at an average home price of $550,000. You can kind of look back in time and see that it's pretty steady growth in this area. Reason number 1, we have the federal government as a basic employer in the Washington, D.C. area. It's a very stable place. You notice it follows this pattern, almost like stair steps. Time of year, those little peaks are the spring, those little valleys are the winter, right? And so that's the Washington, D.C. area. It's almost as predictable as the U.S. economy, very cyclical, always in the long run growing. But then we go to an area like Hagerstown. So this is Western Maryland, Martinsburg. And the median price at the midpoint of 2022 was $260,000, and a little bit more of an erratic pattern in Hagerstown. So we're getting out into more of a rural economic center, a little bit further away from the big city. And the patterns are a little bit different. We've got some times in the last 9-10 years where we've had some significant declines in value, right? But overall, it's grown quite well. And then we'll take something like the Wilmington, North Carolina area. Okay. Good value right now, $390,000, but it hasn't always been the best performing. We still show, because I firmly believe real estate is a long game, we still show equity appreciation from 2013 to 2022 of almost double, right? But we also see some points in time where we have some big drop periods in the growth, in the year-over-year growth. So we have to decide if it's a cash flow investment, we probably want to go to those areas where the costs to acquire are lower, so that you're cash flowing or not borrowing as much as you get into that investment. But if you're an equity investment, we probably want to go to areas where things are safer. All right. It's less about the cash flow and more about the predictable growth that you're going to see. And so those are factors that really matter as you're considering on where to invest. Is your big economic centers are more reliable, and they're more reliable growth patterns for equity. Your more rural, more remote areas, maybe your smaller towns, your secondary markets, going to be a little bit more volatile, but your costs of entry into buying the real estate is going to be lower than it is in the bigger cities.
Absolutely. So the next item talks about, or we're going to talk about options to finance your real estate investment. So there's several options, and we're going to go over some of them that might interest you.
You have to decide, are you trying to use leverage or not? And so at the beginning, you may not have much of a choice. It depends upon how much cash you have access to, or whether you have the ability to gather the cash. So one option, of course, is the cash that you've saved for the investment. Or if you've got other investments, you can do something like what's called a portfolio loan. And that's where you go to a bank or a lending partner and show assets, and they allow you to borrow against that based on the equity. So you're putting your portfolio up as collateral. Other things you can do is you can borrow from your 401k or from your retirement fund and pay your 401k fund back over time. So you're essentially paying yourself interest. And then there are things you can do if you own real estate already. If you have a favorable relationship with a lender, you can do an equity loan to draw cash against your equity that you have in that real estate and use that cash for your purchasing power. My general recommendation I make to our partners and our customers is try to use leverage for convenience and not for necessity. So you want to get to a point where that's a decision as opposed to a requirement. Oh, if I can actually use some leverage on this one, I can add to my portfolio with these benefits. Generally, you want the leverage to allow your return on your own personal cash or your return on your own equity to be better than if you didn't have the leverage. And so that's why you're using it. And so rates have been going up. And if you're looking at a debt service coverage ratio that's going to be closer to 1 or negative, then you might not want to be borrowing for that asset. You might want wanting to try to use cash or some of these other options of raising cash if the rates are more favorable that way. Stacey, another option we talk about often is a private lender. Yes. So perhaps you have somebody with some funds that wants to partner with you or loan you the money for you to fill out whatever the acquisition price is. There also are options out there. They're called hard money lenders. So perhaps you need a hard money loan. The rates are typically a little higher, usually pay an origination fee, but to bridge a gap between you actually coming up with the cash or having better options or better rates, you can fill the gap with a hard money lender on a temporary basis. Mm-hmm. Other things, Stacey and I often deal with conventional bank financing. So Stacey, talk about that, what you see with that.
Yeah, so rates are up, so that's making people pause. They were, you may know, were 2.5 not that long ago, and they've had several hits up and up, and so now it's about 7.25 or 7.75, I think, today, if you have over 700 credit and a really good job. So it's, probably even more if you have, if the person has some issues, right? But one thing you can do when you're doing a conventional loan is you can get a gift from a family member. And that's key if you need to bridge the gap with the money that you have and the money that you can potentially get as a concession from the seller, which is kind of a whole nother lane, which I can get into another time. If you're interested, definitely give me a call and I can explain that. But you get your conventional loan through a mortgage lender. They pre-approve you before going out to shop for the home for a certain price point. And they're going to break down to you what that means with taxes, insurance, any condo fees, HOA fees, all that stuff. And then whatever your mortgage is going to be. And you may need a certain amount of money to go to closing. Okay. So you may be putting down, say, 5%, 10%. There's other types of mortgages besides a conventional loan, but there is something called an FHA loan. If you're military, there's a VA loan. So there's lots of options out there. So we'll work with you alongside with your mortgage lender to figure out what the best one is for you. But it's good to know that you could get a gift from a family member. And that means, say, your parents or a brother or sister, you have to just have them sign a letter that says that they are family and that it's not a loan, it's a gift. Okay. But it is an option, and it is something that people use all the time. Right. Some people get that money in lieu of, some other thing, like maybe a graduation gift or a wedding or something like that. Like family members give money for those kinds of things to purchase a house because a house is an investment, so, but I know Ed's going to talk about small business loans, but I don't want to forget to mention briefly, Ed, too, if you would touch on a 1031 exchange and what that means for an investor.
Yeah. So just like there's a variety of asset types in commercial, there's a variety of loans. And so when we counsel with our customers at the beginning, we encourage them to meet with a community banker and understand what the wide array of possibilities that are there for them to do an investment loan in commercial real estate. If you're buying commercial real estate for your own business use, oftentimes you can have access to small business administration loans. So the U.S. federal government has the SBA, or the Small Business Administration, and they exist to promote and help small businesses do great things. And so they often will make very low interest loans for pieces of the amount of equity that you need or amount of leverage you need to have to complete the acquisition to invest in the small business or in your small business. So small business loans are common. Can't really do them for investments, right? So investments, you're typically looking at commercial real estate investment loans, just like you would be looking at residential real estate investment loans. The lenders are different, as I mentioned, and the options are as wide and diverse as there are asset types in commercial real estate. The 1031 exchange, the layman's term that the layman's method of explaining this, I say, is if you have an investment, the U.S. tax code allows you to, when you sell that investment, use a 1031 to roll the proceeds into another investment and defer capital gains if you cover your book value when you make the exchange. So for example, if you buy a house that you have as an investment for $200,000 and a couple years later sell it for $300,000, before you go to closing, you can tell the title company and hire a qualified intermediary. It's an actual role that exists as a result of the tax code to say that I'm going to use a 1031 exchange. Now, the U.S. federal government does put some rules on that. So they're going to make the intermediary hold the money. So the key thing is for you to get this benefit, the money never comes to you. It goes from asset to asset through that third party you hire. And then they say, after you close on the asset you sold, you have 45 days to identify 3 potential target investments, and you give those to the intermediary. And then you have 180 days to close on one of them, at least one of them. And what happens is the intermediary then rolls the money to the title company on the one that you're buying and basically make sure that that pocket of money and that gain you had is actually transferred to a different asset. And so you think about that, the federal government likes that, the state governments like that. State governments make their money off real estate transactions, and county governments make that. So they like the idea that transactions happen because they collect grantors and grantees taxes and fees. And the federal government likes that because it's promoting things happening in the economy. It's part of the progress in our economy. And investors like that because it means they don't have to pay capital gains taxes until they're ready and they can actually change from one investment to another. Stacy, one other way that you can finance an investment that we didn't touch on, it's kind of related to the cash option, is to form a syndicate or a partnership. So you get a group of people together, maybe 6 people that all have a pocket of money, and you form an LLC and you buy an investment together. You do have to have somebody be an administrative partner for that to handle the distribution of money and the collection of money as things need to be done. But this allows someone to step up into an investment they maybe couldn't afford on their own. But perhaps you get people that participate and everybody benefits in the long run, both from cash flow and equity and tax savings through depreciation, and if there's any leverage from principal pay down.
Exactly. Perfect. So do you have any questions? Excuse me. Do you have any questions, Sabrina?
A lot. That was a lot of info. When you read these books, they make it sound, because there was a section on what he was talking about in that Rich Dad, Poor Dad book, but he made it sound so simple. Oh, you just transfer from one asset to another and don't have to pay taxes.
Right.
Right.
You have to pay them at some point, but you just don't have to pay them right now if you do it right.
Okay.
And one disclaimer, Stacy and I are not CPAs, not attorneys, and not financial advisors. However, it's key to have those professionals and a person like a qualified intermediary in your network, part of your team. Yep.
Right.
So we have one we work with on a regular basis, and I give a simple explanation of 1031, but when they start to ask really complex questions, I always defer to him. I say, you should really pose that to the qualified intermediary. And if they ask a question about how much they need to cover on their transfer, I usually refer them to their CPA, because their CPA is the one that's tracking their book value on their asset and will have a better idea of what their gain exposure might be.
Okay.
Yep, exactly. So, but high level questions now, anything else that you're wondering about tonight?
Well, how does somebody get started in buying real estate if they're not familiar with any of this?
So
Or is that,
I would start with where you live to buy the home for yourself first, to take care of yourself. Because when, we talk about interest rate, so your interest rate, instead of being 7%, let's say, it's 100% if you're renting. Does that make
yeah,
sense? So
yeah,
you're paying the landlord, and the landlord's getting rich because they own the property, and they may own it outright. They may not own anything on a mortgage. And just every month, if someone's paying, $1,200, they're just taking the $1,200, right?
right,
And
Our
they're
feeling
paying,
is you're paying for the property anyway. You're buying the
Yeah.
property anyway. You're either buying it for the landlord or you're buying it for yourself.
one
Mhm.
idea to start on your first one is to say, I can qualify for this. I don't really want to spend all this, but I'll qualify for it. I qualify for it because I talked to my mortgage lender, and it has space to have a roommate. It has a basement. It has access to that basement. That other person can come and go. So you can rent out potentially the basement if that's allowed for the rules and with wherever you are choosing, right? You have to check all that local stuff too. But or maybe it's a 2-bedroom, 2-bath, and they're 2 suites, right? One on each side of the house. And maybe it's a friend or a family member who also needs a place to stay. So you can purchase the home and then rent out the other space. And that way it's buffering your load every month. So you're building equity and you're only paying, a portion that's for yourself, and you're getting the other portion. Or maybe you get a house that has 3 bedrooms, and the market rate for the 3 of them paying, the 3 other people, let's say 2 or 3 other people, whatever you decide, pays for the whole thing, right? And then you're basically living with just paying the taxes and helping with utilities and that kind of thing. So
Okay,
that's another way to leverage. We had some people that owned a single family home, but they made, it was on a hill, and they made the basement side door, the access door, and just built a little apartment with a little kitchen down there. And it didn't cost that much, and they were handy, but it helped so that they could rent that out for, like $900 a month. And that really put a big dent in their payment, right?
right, yeah,
Yeah. So they offered, Wi-Fi included, and, I think
very creative.
like maybe,
Mhm.
it offered the water and some stuff, and maybe they paid for some other utilities themselves, so that's up to you how to work it out. But yeah, just sitting there brainstorming with people, sometimes we come up with a good, solution that's going to work for their area and what their personal situation is. And maybe you don't know anybody that wants to move in with you, but maybe it's secure enough, like the basement or something like that, where you could potentially just not ever really see that person, not have any co-living space at all.
Exactly, okay,
Yeah,
I,
so lots of
I, yeah,
ideas there.
yeah,
I'd also think about how involved you want to be in the investment. Now, if you want to be, so I'm talking about investments separate from your primary residence. So assuming you own your primary residence first, if you're going to make real estate investments, do you want to be participatory in it? And so most people will start with a second residential real estate investment for the reason that they're most familiar with it. Plus, the rates are going to be a little bit lower than they are in commercial if you have to borrow. Most people also start there because they don't have as much capital. And commercial real estate investments can be more expensive than residential real estate investments. So
oh,
usually that's a good place to start. With the key is you want to make sure that you're growing your wealth through this process. So whether it's going the path of the flipping, where you're buying the real estate and then adding value to it and then selling it for a profit, or going the path of the cash flow, which is you're trying to buy it to collect the rent. The key
right,
though is cash flow is your goal. You've got to have a good stake in the real estate investment of your own and borrow less, particularly in an environment where rates are rising. So you want to make sure that you're breaking even or growing your cash flow through the process if that's your goal.
okay,
Yeah. So we're happy to have a one-on-one with you later, or anyone else that is watching this later, to talk specifically about what, goals you have and what you might want to do, and then connect you with someone in your local area, because we do refer people all over the world. We have offices in Italy and, every other country pretty much. So, but definitely personal connections all over the United States that I can say, immediately, like, I know this person and I'll connect you with them today, type of thing. So
Okay.
happy to do that for you so that you can get on your way with getting the information that you need. And it might not be something, and I tell people all the time, don't be scared to make that first call, because it may be something that you're planning for the next 6 months or a year. People don't
That's
just call
right.
up and buy a house. I mean, we plan it out, and we talk about the whole process of what it takes to purchase a home. And in residential, you start with finding a good realtor first that can guide you to a trusted lender, a mortgage lender that's going to help you, and then figure out your area, figure out what your price range is, figure out what type of property you want. Like I said, a single family house, a condo, like, what do you want to do? Because with a condo, you're going to pay a big fee with the condo, because they're going to take care of the outside and the roof and the lawn. And while that's great, but you may not want to be sticking all that money into a fee to the condo association. You may want to have a single family home or a townhome where you're paying a lower fee, but you're responsible for those outside maintenance things. And it's just a preference. Different people feel differently about
Right.
what's best for them. Some people, as they age, they want a condo because they're like, I'm tired of mowing grass. I don't care. I don't need a yard anymore. Like, that doesn't interest me anymore. But when you're starting out, people might not be able to afford that, but they're working their way up to potentially a single family house, especially if they have a family and they have pets, they want to have a fence and a yard. There's lots of different reasons why people move. And so there's always different types of properties available. And that's what your realtor can help you separate and discuss and figure out what's best for you. And it doesn't have to be your dream home the first time. Just get in, I say, just get into some property, because even if you don't want to live there long term, live there a year or 2 years, rent it out, get the next one, right? Just keep building on that. And you just have to start somewhere. But like they say about the trees, right, Ed? The best time to plant a tree was yesterday. So the best time to connect with a realtor was yesterday. To connect with a lender was yesterday, because you want to, get in before the rates change too much or go this way or that way, depending on what market you're
Right.
in. And make sure that you're really understanding what's happening in that market. And maybe you say, hey, I work from home. I don't need to live right here in the city. Sorry, someone's texting me. I don't need to live right here. Maybe I can live a little further out now, because I don't need to get to all these things like I used to. And it's worth it to move out a little bit and build equity in like the next city that's coming, So as far as like relevant to DC, it's like people want to live in DC because that's where people work and it's easy. But then you move out to the next county and the next county and the next county, right? And as you go out, depending on what it is, it could be a little less expensive, but then you have the drive, right? But if you're working online these days, maybe you do want to invest a little bit further out.
Right.
Live there forever. Just somebody's going to live there, though. You can rent it.
Okay.
So, and then maybe you build equity and you move further in, because maybe your reasons have changed by then.
Mhm.
So it isn't a forever thing. It's just, you can buy and sell, or you can hold. Maybe you end up holding 2, 3, 4 properties. We said we were going to talk about North Carolina, but what we chose to do was purchase some vacation homes. And so that way we get to vacation there, but we also rent it out a lot in the summer in the hot months, and hot, I mean temperature, and hot meaning people want to come, right?
Yeah.
So you can make a lot per week, right? And that can pay for your whole year just by having a good couple summer months. And then the other times of the year, you can enjoy it with your family and do other things.
That's right.
Yeah.
I would offer in commercial, it's the same answer. Find a commercial real estate broker that knows the area that you're looking to invest in and have them become your partner. I often say when Stacy and I help our clients, we're like the quarterback. So we help network with the lender. If there's an attorney required, a 1031 intermediary, your CPA, with the client at the center. And we're really trying to help you score, really. We're trying to help you find an asset that's going to make the most sense for where you are in your real estate wealth building journey. So early on, sometimes residential is the best place to start. Try to go for an asset where you're a little bit more cash intensive, unless you can find a good low interest rate for the borrowing piece of it. But as you switch into commercial, if that's a route that you go, just know the rates are going to be a little bit higher. and the loans are going to be all over the map on what you can choose from. So it starts to get a little bit more complex. Sometimes it's better to start simple and small and then spirally growth over time as you actually continue to grow wealth.
Okay.
So any other questions now?
No, not that I can think of right now.
Okay. Well, no worries. Well, we're here to help. So I think you have my number, but I'll read it out or say it out loud for anybody else who's maybe watching later. So it's 703-795-3959. And Ed might want to leave his.
You can find me at 703-867-3350.
That's right.
Thank you.
Well, it was a pleasure meeting you, and just give us a
Thank
call
you.
if you want to talk further, okay?
I will. Thank you.
Thank
All right.
you
Have
so
a great
much.
night. Thanks.
Right.